The market's gearing up for this decision. Maybe we'll stay with this, Jen. You want to talk over this? You can do that.
Absolutely. Happy to do it.
All right, let's keep looking at pictures. That's a great idea. But joining us now, and we'll get a shot of her later with her take on the market, just so you know it's really her, not someone imitating Jenny Johnson. It really is the CEO of Franklin Templeton. Has $1.6 trillion in assets under management. That might be bigger than the UK. No, I'm kidding. It's not. Fed Day, right? Let's bring it back to this.
Yes.
Bring it back to this country.
Yeah. What do you think?
25 basis points. What do you want?
I think it's 25. I think, look, you had the revisions in the employment of the 900,000 jobs, but the reality is that was really backward looking, right? And so if you actually look at what's going on, you had wage growth at 4%. In some cases, it was 5%. So that's kind of an indication that there's a pretty robust labor market. Retail sales are up. Consumers still spending. Yeah. Inflation's pretty sticky at 3%. I think it's a blurry picture. And so then I ask, and I know non-farm payrolls are down. So you ask, well, why is that? Why is it that it feels like this could be a balance? Well, we went from 3 million immigrants in 2023 to 1 million and probably less. So you have less people coming into the workforce. Productivity, which had for a decade had been 1 to 1.5%, is now 2 to 2.5% in the U.S. So businesses are getting more productive. You see it in corporate earnings. I mean, I think that it's a blurry picture. And if I were Powell, I'd go with the 25%. He's got October and he's got December, or the FOMC's got it, and they can.
So you're not even looking necessarily at the potential for greater inflation. You're just saying, based on the economy, if you really look at the numbers with the understanding of changes that have taken place over the last year or two from our demographics and beyond.
I think the economy is pretty robust. I mean, yeah. I think there's an argument for no cuts, but I think in Jackson Hole, he made it clear that he was focused on employment and he's got concerns, and there are, he doesn't want to be behind the 8 ball here. And so, I think he's kind of indicated to the market that that's where he's standing. He's looking at that. Again, I think the data still shows a pretty robust economy.
There are also questions about what the Federal Reserve can really control. If the problems are things like housing, they don't control the long end of the market. You got to be careful with that. If you are talking about productivity gains because of AI,
no.
Employers, okay, it's not because of AI, but if you're talking about productivity gains, you're not necessarily going to spur the employment market with Fed cuts either.
That's right. So first of all, I think AI, look, all companies are trying to figure out, and it is powerful and it is fast. But we haven't seen the productivity yet, I think, in the numbers. This is really the technologies that have been the last decade, right, that are coming through, and you change. It takes time for it to get built into the business process. So I think that's coming, which is the AI productivity. But I think that you also have to look at the dynamics of the labor market. Like, the fact is this reduction in immigration is pretty significant. And so companies haven't had to hire, which is also why I think people see it and say, well, I'm not going to change my job because I'm not sure kind of how this plays out. But there's no question there's been, and it's really a U.S. phenomenon. You haven't seen the same kind of productivity improvements in other economies.
We don't get new highs every day, but it seems like we get them every week, which if you hit a new high a week after the last week, that's another new high. So, and I guess what I'm getting to is cutting into a stock market like this is a little odd, and it's part of a commentary on how mixed a lot of the data that we're getting is. So is the market already going up because of the easing cycle that we're in front of, or is it going up because of deregulation, because of something this administration has done right, in spite of what we heard about tariffs, in spite of what we hear about inflation and jobs slowing?
Look, I think the right answer for the Fed is to ignore the market, right? That actually is not a great indicator for the Fed. So hopefully they're ignoring the market. But if you look at the underlying market, and we may have corrections up and down, but think about some of the tailwinds that you're going to have in 2026. Fiscal and monetary policy, you've got tax cuts, and I like to call it tax extension, but they're kind of front-loaded, so they will be a real tailwind. And then you're likely to have some amount of interest rate cuts. Those are going to be good for the market. So I think whether we get some corrections here or there, I think the market's going to remain pretty strong. And you see it in corporate earnings. It's not like the corporate earnings aren't good.
You're running a company. You're not, I don't think, the strategist necessarily at all of your Franklin equity funds. But were you expecting, with the tariff backdrop and some of the other things that we've seen, were you expecting the market to just keep chugging along and the economy to keep chugging? And how did that happen with this tariff uncertainty?
Well, first of all, let's remember, tariffs are not that big of a problem for the U.S. I think it's, imports are like 14, I may have it flipped, imports are like 14% of GDP and exports are 11%, right? So that's actually not really our problem. You're Germany and it's 50%. It's a problem for you, right? So first of all, I never thought of tariffs as being a huge problem for the U.S.
A lot of people did.
Sure, and for individual companies, that can be an issue. But the other thing that happens with tariffs is it takes a little time, but companies change their supply chains to adjust it. And it's also a one-time inflation step up, right?
Although it's harder to change your supply chain this time around because it's everybody. It's not like you could say, I'll bounce to Vietnam.
That's right, and so they did find that, for sure. Yeah. And again, it's probably going to level out at about 15%. But remember, from an inflationary standpoint, it's a one-time event.
Right, the second derivative is not, like exactly. I saw a horrible headline on drugs that grocery prices are the highest they've ever been. It's like inflation goes up every year. It was, got up to 9%. Now it goes up 3%. So the 3% on top of 9% is an all-time high.
Exactly.
And my grandmother used to talk about how they thought it was inflation when the ice cream cones she used to buy went from 3 cents to a nickel. It's like prices go up over time. That is what happens.
Right.
But when it happens right after the consumer has just felt that big pinch, I think it's a tougher political
for sure, but wages,
if
wages are up 4%, they can absorb some portion of it.
Yeah, but there is this tale of two economies, right? The upper end versus everybody else. And that's where you get things like Mamdani, why he has made such inroads in New York City as a result.
Yeah. No, and I think, for sure, we all know that once AI becomes a more effective productivity tool, it's a question about, like, where do you hire college kids? What happens to all those kind of jobs? I know what we're looking at is actually thinking about, like, a 2-year college program where you just say it's a college, kind of like the old associates programs that used to, a lot of Wall Street did in investment banking and others. And because, here's the other side of it, a college kid is used to using AI in their everyday life.
Right.
We have to think about using it. And so you want to make sure, I think, as companies, that you're infusing your workforce with people who just...
And where do you get the leaders of tomorrow if you're not hiring entry-level jobs? Yeah. When you say a college program, you mean...
So a college grad program.
Oh, after you graduate.
Yeah, after you graduate. But you would state, like, this is a 2-year program. And then it allows you to hire what you need to hire. But it's hard to know what you're hiring.
And then we don't know if we keep you.
Well, then you have all this experience. That's right. And so then you say, well, you can go back and get an MBA. It's actually, the investment banking firms have been doing it for years.
Yeah.
But it's a way to ensure that you continue to infuse that sort of younger generation, which I think are much more tech savvy. My kids, 5 kids, they're 10 years apart. My older one will say the tools that the younger one uses are completely different, and the apps they use and others. So you need to keep infusing that in a company.